Picture this. You own a business. You have customers lined up around the block. You are selling products faster than you can make them. Your accountant tells you that your net income is huge. You are rich, right? Wrong. The next day, you declare bankruptcy. Why? Because while you had profit, you didn't have cash. Welcome back to the channel. Today we are talking about the lifeblood of any business. In the world of accounting, cash isn't just money, it is the ultimate measuring stick, the fuel for the engine, and the single most dangerous asset you own. Let's break it down. Part 1. What actually counts as cash? First, let's clear up a definition. When accountants say cash, they don't just mean the crumpled bills in your pocket. On a balance sheet, the first line you will ever see is cash and cash equivalents. Cash and cash equivalents. This includes 1. Currency, coins and bills. 2. Bank deposits, checking and savings accounts. 3. Cash equivalents. These are super short-term investments. Cash equivalents, things like treasury bills or money market funds that are so safe and liquid, they are basically as good as cash. Don't forget, the golden rule here is the 3-month rule. If it matures in 90 days or less, it counts as a cash equivalent. Part 2. Liquidity and the fuel analogy. Think of your business assets like a race car. You have a factory, the engine, inventory, the wheels, and patents, the aerodynamics. But cash. Cash is the fuel. This is why cash is always listed at the very top of the balance sheet. Accounting standards require assets to be listed in order of liquidity, meaning, how fast can I spend this? Cash? Immediately. Inventory? You have to sell it first. Buildings? Good luck selling a warehouse in 24 hours to pay your electric bill. This is why a company can be solvent, having lots of assets, but illiquid, having no cash. If you can't pay your employees on Friday, it doesn't matter that you own $1 million factory. You are in trouble. Part 3. The Truth Serum, Statement of Cash Flows. This brings us to the most important document for tracking cash, the Statement of Cash Flows. Many investors say the income statement is based on opinions because of estimates and accruals, but cash flow is a fact. This statement tracks how cash moves in 3 specific buckets. 1. Operating activities. The cash you made from actually doing your job, selling coffee, writing code. 2. Investing activities. Cash you spent buying long-term stuff like equipment or buildings. 3. Financing activities. Cash you got from banks or investors. If your business is burning more cash in operations than it's bringing in, you are bleeding out. No amount of accounting magic can hide that on the cash flow statement. Part 4. The Danger Zone, Internal Controls. Finally, we must discuss security. Because cash is universally accepted and leaves no paper trail if you just hand it over, it is the asset most susceptible to theft. That's why accounting isn't just about counting, it's about control. We use something called segregation of duties. The person who opens the mail and touches the checks should never be the same person who records the deposits in the accounting software. If one person does both, well, that's how you buy a yacht on the company dime without anyone noticing. Conclusion. So, remember, profit is a theory, cash is reality. It's the unit we measure value in, the tool we use to pay bills, and the first place auditors look for fraud. If you want to learn how to actually prepare a statement of cash flows without pulling your hair out, check out this video right here. Thanks for watching, and keep your books balanced.